You look at the patient charts in the ward today, here in August 2026, and you don't see human names. You see legacy institutional lenders. You see massive commercial banks, Wall Street special servicers.
And their vitals are completely crashing. I mean, the system is just going into total shock.
Right. Patient presents with a severe, highly contagious case of involuntary asset ownership. Today, we are reviewing a clinical diagnostic report authored by lead examiner Priyanshu Adithagar, or PRI. We are tracking a structural cognitive decline where massive financial institutions are accidentally becoming hotel operators. And listen, by the end of this chart review, you will understand exactly why this specific delusion destroys investor capital and the exact surgical interventions required to preserve your portfolio.
Because, as Pre notes in the patient's chart, this isn't some minor accounting error. It is a terminal infection. They are bleeding equity daily.
Exactly. So let's break down the core mechanics of the patient's underlying financial symptoms. The primary complaint on the clipboard is non-accrual loan bloat, heavily driven by unhedged debt maturity walls.
It's the classic floating rate trap. I mean, think back 3-4 years ago. These borrowers levered up on massive hotel portfolios using short-term floating rate debt. And they bought interest rate caps, basic financial life support, to keep their monthly payments artificially low.
But it's 2026 now. Those caps are expiring. The life support is gone.
Right, the plug gets pulled, interest rates are structurally higher now, and debt yields have severely compressed. So look, the hotel might be generating the exact same top-line revenue it was 3 years ago, but the monthly debt service, the mortgage payment, has doubled, sometimes tripled. It is just mathematical asphyxiation.
So if you are the distressed borrower in this scenario, your revenue literally cannot cover the new unhedged loan costs.
Yeah.
And refinancing is a joke, because no sane underwriter is touching an asset where the math is completely upside down.
Right, you have zero options. So they choose the only rational exit available. They execute a deed in lieu of foreclosure or a structured debt for equity swap. They just hand the keys back to the lender and walk away.
Which triggers the real pathology we are looking at today. You have a conservative commercial bank, an entity structurally designed to manage paper, assess risk, and, passively collect interest, suddenly owning a living, breathing, volatile, 24/7 hospitality business.
And this brings us to Pri's boots-on-the-ground diagnosis of this delusion. He calls it the accidental operator delusion. These lenders, these credit committees, they suffer a profound paper-to-operations shock because they actually hallucinate that they are insulated from the chaos.
Right. They look at the file and say, oh, we have a third-party property management company in place. It's fine. We're safe.
Which is completely unhinged. I mean, they view a property management agreement like it's an autopilot switch. It is not. The manager is the engine, sure, but the owner still has to buy the gas.
Exactly. Property managers deploy your capital. They don't fund the payroll out of their own pockets. If there isn't an active, deeply capitalized sponsor, an owner willing to aggressively approve dynamic pricing or inject working capital for payroll every 2 weeks, the asset's performance just flatlines.
A bank is essentially a toll booth operator. They build the booth, sit inside, and passively collect a fee as the cars drive by. Taking over a distressed hotel is like telling that guy in the booth, well, the highway is yours now. You have to pave the asphalt, you have to build the cars, and you have to negotiate with the unionized drivers.
They simply do not have the institutional machinery to do it. A hotel is an extreme daily micro-business. Your tenant's lease doesn't last 10 years. It expires every single morning at 11 a.m. at checkout.
Right. You have daily fluctuating room rates, you have perishable food and beverage inventory.
And sudden massive capital hemorrhages. Say it's Thursday afternoon, you have a fully booked wedding weekend ahead, and the aging commercial HVAC system just blows out.
You need $1 million chiller replacement authorized in 2 hours, or you're refunding 300 angry guests.
But the bank's credit committee, which meets once a month and requires 3 layers of risk officer sign-offs, is structurally incapable of making that kind of rapid-fire entrepreneurial capital decision.
They freeze. They stare at the paperwork. And while they are paralyzed by this paper-to-operations shock, the asset actively rots. The online reviews plummet. The good staff quits for a competitor. The revenue just bleeds out.
And here is why you, looking at the broader market, should actually care about this localized stupidity. Why does it matter if a Wall Street bank is terrible at running a mid-market hotel? The answer is systemic balance sheet bleed.
Right, the regulatory component. When a bank takes back a commercial property, it enters REO status, real estate owned. But regulators don't view an operating, deteriorating hotel the same way they view a stabilized office park.
Be treated like a biohazard.
Exactly. The regulators look at that operationally complex, depreciating asset on the ledger, and they mandate severe capital adequacy reserves. The bank might have to lock up massive amounts of its own liquid capital just to cover the potential losses of that specific hotel.
And that capital is now trapped in quarantine. If a regional bank has to lock up $50 million to cover the operational losses of an accidental hotel empire, that is $50 million they cannot lend to the actual economy. It chokes off liquidity for everyone else. Small business loans, construction debt, it all dries up because the banks are stuck playing hotelier. But here is where the pathology reports actually get weird.
The psychological refusal to accept the diagnosis?
Yes. Moving on to our next major pillar, how this underlying delusion was surgically corrected. Because Pre's report abruptly shifts from diagnosis into a rigorous triage framework. The bleeding has to stop.
And Pre, functioning as the sole sane commercial real estate investment advisor and licensed realtor in the Central Ohio and Midwest markets, maps out 3 very distinct treatment paths to salvage the remaining equity.
Let's look at the first ward in this triage framework. Flagged full-service hotels. We were talking about the big luxury brands, the massive properties with conference centers, global name recognition. Premi notes in the clinical assessment that these assets suffer from negative cash flow, which is heavily exacerbated by unviable brand mandates.
Right, we need to talk about the PIPs. Property improvement plans. The global brand dictates strict, non-negotiable capital expenditures to maintain their image. They tell the distressed owner, look, you must renovate the lobby to our new 2026 standard. You must replace all the hallway carpets.
Costing millions of dollars. But let me push back on the psychology of this. If I'm a bank and I just involuntarily foreclose on a dying hotel that cannot even cover its debt service, how on earth does a credit committee justify sinking $5 million into custom Italian marble lobby furniture just to keep a corporate logo on the roof?
It is the literal definition of throwing good money into an incinerator. But institutional inertia is a hell of a drug. The instinct to maintain the status quo is what gets lenders killed here, which is why Pri's prescribed intervention is so brutal. You do not fund the PIP. You surgically amputate the brand.
But how do you actually execute that? A brand franchise agreement is an ironclad 20-year contract with massive liquidated damages for breaking it. A bank can't just send an email and say, never mind, we're taking the sign down.
No, they can't. Which is why the prescription requires bringing in a specialty receiver and a restructuring advisory team. A specialty receiver is an independent, court-appointed expert who takes total operational and legal control of the asset.
They operate as an officer of the court, not just a standard corporate owner.
Right. So they possess the unique legal scalpel to stabilize the property. They can aggressively petition to reject executory contracts. They terminate those unviable brand franchise agreements, and they renegotiate the crushing third-party management contracts. The whole strategic target is to stabilize RevPAR, revenue per available room.
You strip away the suffocating overhead of a luxury brand standard that the local micro market simply cannot support anymore. And you run the property as an independent asset to stop the cash bleed.
It is pure financial surgery. Amputate the brand to save the building.
Okay, so that's the treatment for fundamentally sound buildings trapped in toxic contracts. Let's look at the next tier in Pri's triage framework, which focuses on severely impaired paper.
The terminal cases, the classic underwater asset.
Right. This is when there is no luxury brand to strip away, and the physical building itself is practically worthless compared to the debt. The note balance drastically exceeds the physical valuation. Say the bank is owed $25 million on the mortgage, but the hotel is only worth maybe $12 million on the open market today.
The clinical treatment prescribed for this condition is what Pries calls discipline disposition horizons. The directive is absolute. Sell the non-performing paper immediately, execute a DPO, a discounted payoff, or trade the note entirely to opportunistic fiduciaries.
Take the loss and walk away. But credit committees notoriously despise doing this.
They hate it. And this is another psychological hurdle. The institutional instinct is to extend and pretend. They delay the inevitable, hallucinating that the market will magically recover simply because they are terrified of realizing a $13 million loss on their quarterly earnings report.
But this is exactly how Pre saw the symptoms before the family portfolio was traded away in previous cycles. Delaying this realization guarantees what he calls asset rot. And again, this goes back to the mechanics of a hotel as a living entity. If an office building sits empty for a year, fine, you dust it off. If a hotel sits in limbo without capital expenditure, the drywall literally decays.
The good staff leaves, the service tanks. The online reviews plunge to 1 star, and the underlying value of that building drops from 12 million to 6 million.
But refusing to take a haircut today, they guarantee decapitation tomorrow. The paper is fundamentally impaired. The treatment is disciplined disposition. Sell the note at a discount, clear the toxic asset and the regulatory capital penalties off the balance sheet, and let an opportunistic buyer with actual turnaround expertise handle the corpse.
Which leads us perfectly into the final triage category. We've covered amputating the luxury brands, and we've covered selling off the sunken ships. But there is this massive structural middle ground in the crisis.
The distressed limited service and extended stay hotels.
Yes. This is, without a doubt, the most creative and structurally transformative solution in the entire diagnostic report. I mean, think about your morning commute. You probably drive past 2 or 3 aging 1990s-era extended stay motels right off the interstate exits.
Suffering from obsolete room products, compressed yields, and sky-high submarket vacancy. The consumer demand for that specific hospitality product is just dead.
The natural institutional instinct is to view them as teardowns. But this is how Priest saw what the spreadsheets missed. He prescribes the adaptive reuse pivot. Instead of a bank trying to resuscitate a failing, half-empty motel, the prescription is to completely change the asset class.
Right. You convert these hollowed-out guest rooms into stable, multifamily workforce housing or senior independent living units.
The elegance of this pivot is that it simultaneously cures 2 massive macroeconomic diseases. First, you instantly eliminate the paper-to-operations shock.
Because you strip out the daily operational nightmare.
Exactly. When you legally transition the asset from commercial hospitality to residential, you don't need a front desk clerk staffed at 3 a.m. You don't need a massive commercial laundry operation. You eliminate the expensive transient marketing algorithms. You shift from a highly volatile daily business to a stable passive asset where a tenant signs a 12-month lease.
And structurally, extended stay motels are already predisposed for this. Right. They often have existing kitchenettes, partitioned living spaces, distributed plumbing networks that align perfectly with studio apartment floor plans.
Which significantly reduces the required capital expenditure compared to ground-up construction. But the second macroeconomic problem this solves is even more profound. Across the country, municipalities are facing a severe structural shortage of affordable workforce housing.
It is a crisis everywhere.
And here you have these physically sound, concrete and steel structures sitting on decent real estate, fundamentally misaligned with consumer demand. They shouldn't be hotels anymore. By repositioning the asset, you cure the bank's balance sheet bleed by feeding a starving housing market.
But the actual mechanics of that pivot are highly complex, right? You can't just slap an apartments for rent sign over the motel logo.
No, the legal and zoning mechanics are brutal. You have to navigate local municipal planning boards to rezone the parcel from commercial hospitality to multifamily residential. You have to ensure the building envelope meets strict residential fire codes. But, as Pri points out in this week's Perspective, cities are so desperate for workforce housing in 2026 that many municipalities are actually fast-tracking these zoning variances to incentivize developers.
It really is the ultimate silver lining to this entire debt-to-equity seizure wave.
Yeah.
Sometimes an entire sector has to hit total organ failure, and properties have to change hands involuntarily before the market is logically forced to reposition those assets into their highest and best use.
It is a painful but necessary purge of the system.
So let's issue the final discharge directives.
Yeah.
The bottom line. Right now, commercial lenders are caught in a systemic debt maturity trap. They are drowning in hospitality assets they never wanted, and pretending they can simply manage them via third-party autopilot agreements is a fatal delusion that will destroy their balance sheets.
The discharge directives from Pri's report are absolute. First, execute immediate operational triage. Banks must abandon their legacy complacency. They need to appoint specialized hospitality asset managers and receivers to audit daily procurement, challenge the brand mandates, and stop the cash bleed.
Second, if the asset is an obsolete limited service property, pivot immediately. Assess the architectural and zoning feasibility for an adaptive reuse conversion into workforce housing.
And third, if the paper is severely impaired, sell it. Maintain a disciplined disposition horizon. Take the structural discount today before asset rot destroys whatever principal you have left tomorrow.
But we really have to emphasize the stark compliance warning embedded at the end of the clinical report, because this isn't just an academic exercise.
No, it is a massive liability warning. Executing these loan workouts, appointing receivers, or attempting to operationally reposition these assets without rigorous forensic underwriting is incredibly
You
dangerous.
cannot just wing an adaptive reuse conversion or a deed in lieu.
Exactly. Doing so carries the potential for a total loss of principal. These are highly complex legal, tax, and operational maneuvers. Investors, traditional lenders, and credit committees absolutely must consult qualified fiduciaries and legal restructuring advisors before deploying a single dollar of fresh capital. As we establish, one wrong move in a distressed debt for equity swap accelerates your capital loss far faster than doing nothing at all.
High-stakes financial surgery requires specialized surgeons. You don't hand a scalpel to a toll booth operator. Which leaves you, the listener, with one final dynamic to monitor after this shift ends. We talked about those DPOs, the discounted payoffs. We discussed legacy banks panicking to clear their regulatory ledgers and offloading severely impaired $25 million hotel notes for $12 million. The report mentioned trading that paper to opportunistic fiduciaries.
The distressed debt buyers, the agile capital waiting in the wings.
Right. Think about who is sitting on the other side of that negotiating table. Who are these opportunistic buyers with the dry powder and the operational expertise, quietly snapping up half-price commercial real estate while the legacy institutions are in full retreat? Because it makes you wonder, is this chaotic wave of involuntary hotel operators actually triggering one of the largest generational wealth transfers in commercial real estate history?
It is a massive transfer of equity. While the traditional institutions are bleeding, a completely new class of agile investors is buying up the core infrastructure of our cities at a steep discount.
It is going to completely reshape who owns the buildings we live in, work in, and stay in over the next decade.
The window to capitalize on it is wide open right now, provided you have the discipline to actually look at the math.
It really is. So the next time you drive past an aging extended stay motel or walk into a struggling luxury hotel lobby, look past the brand name on the door. Look at it like a medical chart at the foot of a hospital bed. Ask yourself, what are the vital signs? Who really holds the keys today? And more importantly, who is surgically positioning themselves to own it tomorrow? We'll catch you on the next shift.
Before you close your app, do us a quick favor. Rate and review the show. It takes 5 seconds, but it directly supports what we do here. Want to get these insights delivered straight to your inbox before anyone else? Head over to bearinvestors.com and join our inner circle today. See you on the next episode.